Despite the president's urgings to take advantage of the unprecedented prosperity around us, wink, and make a larger cut, Fed Chairman Jerome Powell has announced a quarter point cut today. Welcome to the Between the Lies podcast, your weekly lesson on how to approach an uncertain world with positivity and balance. I'm Nicky P, here with my good friends and money brains, Luke Tatum and Rob Brayton from Perfect Spiral Capital. Stick around to the end of the video for their free toolkit, and be sure to like and subscribe if you enjoy the video. Gentlemen, are you excited?
I'm so excited. I got to tell you, Fed messing with the interest rate. There's nothing more exciting than that, right? So, uh, I thought we might start this one by just sort of talking about what we're actually discussing today. I feel like Fed rate cuts are a thing that get thrown around all the time. And you maybe hear that at work or something and go, what the heck? That's one of those econ things. Don't really think about it. Rob, would you maybe break this down for us? Tell us what this actually means?
Yeah, sure. So the federal funds rate, as you mentioned, Luke, tends to get thrown around a lot. People are always worried about this or that. Reality is it's really a target interest rate that the U.S. banks and other types of depository institutions charge each other for overnight loans, for reserves, different capital to meet their reserve requirements, and that's really all it is. And it's at the same time, though, it does have some larger bearing on the economy because we have banks making these decisions based off of their access to capital, these reserve funds. They tend to adjust their deposit rates and lots of other things based off of that rate. Uh, and then it also trickles down into uh, the access to capital for employers, right? So depending upon that funds rate, if money is really cheap, they're going to try to expand and try to grow. If rates are higher, they may try to scale some of that back a little bit. But yeah, so that's in a nutshell, that's kind of what it is and where it comes from.
Awesome. So, my first take on this is I wish they'd leave rates alone and like let them rise more and all that. But that's a very unpopular thing to say. I know Trump is very upset that we're not cutting more, right? It's very politically popular to cut rates all the way to zero or near zero because you're giving away money. It's free money. It's practically bribery to cut rates that much.
So because most people I'm sure have no idea at all like what's going on here. Let's kind of talk just a moment about the bigger macro scenario that we find ourselves in. Um, we are in a place where historically, like we've had rates that go up and down. We're now in a place where it's been decades where we haven't had a real interest rate. They've kept it near zero, sub zero, right around zero for an incredibly long time. And as we're just starting to claw back an actual interest rate, we're already dragging ourselves back down because we're doing so well that we have room to claw back. But it's just that claw back to keep us right to that zero bound marker, right?
Right, right. You've got to have some room to go back down. And so this is kind of a joke in libertarian circles sometimes. It's like, the whole reason you're raising rates is so you can cut them, right? The Fed, that's their main action mechanism. Oh, economy bad, reduce interest rates, right? It's going to stimulate the economy. We've all heard that. We're going to stimulate the economy. You know, uh, what was it called? Quantitative easing, right? We're going to ease up on the economy and make it easier to do business and stuff. We're going to print new money. We're going to lower rates, right? And so it can be very frustrating seeing this when you look. I mean, when I was born, right? I'm a very, very end of the '80s kid, right? And so the Fed funds rate was 8.5 in that neighborhood, like the day I was born. And so that's a lot higher than 3.5 or 3.75, 4.
When's the last time we had a rate that high that you can remember?
I was alive when it happened, but I was so young I didn't know anything about it. I know my parents had to deal with it, right? When they bought their home in the 80s and when they bought their property. But there's what most people don't realize is there's also a side effect to those rates being higher, and that's lower pricing. And that's kind of the big thing that most people are facing right now. And it doesn't mean that those two things always go hand in hand. We also have that other, you know, elephant in the room, which is inflation. And we haven't properly adjusted for that with the rate or the money supply or all these other things. So yeah, I mean, there's a lot that goes into it, but to try to make it easy for people to understand. Generally, when rates are higher, inflation does slow down. And that's a good that actually is a good thing for the average person. It doesn't feel like it because if you go to buy a home or you're addicted to financing through a third party bank, well, yeah, those things are the payment is more expensive, so it becomes harder to afford. But it does in the long term drive the pricing down and things do become more affordable in some respects.
And why? Why does that happen? Because people don't buy as much, right? People are forced to restrict and to get into more of a savings mode and to not get thing today, pay later, right? It shifts consumer behavior. And that's why it's bad to have a central authority dictating what interest rates can be, because they're in some sense dictating what the savings rate is. Not directly. It's all very indirect and obfuscated and very confusing, and it gives them sort of a benefit of the doubt out to every conversation. But that's what they're doing.
The word that we use, in Austrian econ is malformation. We've created an incentive in the environment that's inorganic. And that inorganic incentive is now causing things to function not as they would in a normal environment when things are running properly, but in an artificially induced state. And the the idea of the government is that it's their job to artificially induce whatever state they want. The problem with them doing that is that the longer and longer things go on in that state, the less close to reality and how things actually are supposed to move and would in any normal setting. Like, yeah, they don't care if people save because they can care less how hand to mouth everyone in the country is. Like it's better for them if we're all hand to mouth and have to ask them. Whereas for you, it's better if you don't take the easy money and you do things. But most of us are in situations where it's difficult to make that choice some days. Certainly when money's going to be worth less tomorrow because of inflation, you're incentivized to spend all you can now. So it's weird how to me, it's kind of like the non money guy how they make all these decisions to try and force us to do things that are good for them and like surviving the next day for them but not good for us.
And when we say them, I mean it's like you're more a part of the them crowd the closer you are to the immediate like center of political power, right? So the politically well connected, they may have already known that interest rates are about to get cut. They may have already made their decisions based around what's about to happen with these sorts of things. And so if you're on the leading edge and you've got the money to deploy and you're well capitalized and you're ready to go and you can adapt when the Fed announces a interest rate change, you get to have benefits that other people don't, right? And so again, do what? I don't know what word you're looking for. I'm sorry. Oh, Cantillon, Cantillon. Yeah, 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 exactly. And so, I mean, and it's true, right? It's absolutely true. These money goes through stages, right? If the Federal Reserve goes and buys a bunch of stuff directly, they write a check on the Federal Reserve to buy something. Well, they're paying the price that's current, right? But that creates new money. It inflates the currency, makes money worth less. The next guy, whenever they get the check, when they cash the check and receive the money, they're spending it in a different price environment, right? And so when you or me, when we're 14, 18 stages down the chain, we're always getting, we're always holding the bag. We're always left getting the worst end of that deal.
you want to ask the question if you're in like my position. It's like, well, so what if I were to take information that I have and go and make a bunch of huge financial decisions and move money based on this knowledge that I have that nobody else has? We call that insider trading. But when you do it at the level of the Fed and, let's say the level of the banks that are in that circle that probably already know this stuff because they're all having these discussions together at the same parties. It's somehow not inside trader at that level. It's just business as usual.
Policy decisions, policy meetings, policy briefings.
Exactly. It's certainly frustrating to be, I guess, you know, that far away from like where the money actually holds its value. So what is the difference between like, obviously we said at the beginning that Trump would have liked, I believe, a much larger rate cut versus the point, quarter point cut that we got today. What are the differences if that happens?
I mean, your access to money becomes less expensive, right? So it artificially stimulates the economy to grow, which I ultimately is really where I think a lot of it was leaning toward because I my assumption, and I mean, I'm not a political strategist, but I think I've been around long enough to kind of see things. What's coming up relatively soon? Midterms. Well, if the economy is going well, it helps reward the party that has the power. Generally speaking, economy tends to dictate how people vote in a lot of cases. Not always, but it tends to. And I see it as well. If we can get the economy to churn a little faster, do a little better, it looks really good by the time midterms come around. Now, is that the only reason? I don't know. The other part of it is probably he's getting a ton of kickback and feedback from people that things are really expensive and we don't have enough money, assuming that, if the economy ticks better, employers will trickle or somehow pay more money to their employees. Well, maybe that tends not to be the case in a lot of situations, but I think that's where the motivation for a larger rate cut is likely coming from.
Do you think that a lot of this is him trying to cover up the negative effects of tariffs?
It's very possible, right? Like that's how you would balance some of it for sure. Um, Very true.
It's okay if the thing is more expensive on the sticker because it's got to cover the tariffs now, and of course we know consumers pay tariffs. As long as you get to stretch the payments out over time and use a firm or Klarna or whatever, and not actually feel the full brunt of that up front. Well, it's expensive, but at least it's only whatever percent on the loan. Retail credit cards, things like that, they have insanely high interest rates, but this all will allow them to extend their generous, like no interest terms. Oh, we'll do a 6 months no interest. We'll do a 12 months no interest deal. And then, you get to kind of, it's not really kicking the can down the road, but it's like luring you in to doing things you wouldn't otherwise do, which is the whole game of politics, I guess, in a nutshell.
Now, obviously, part of the show is how we do things different, how we kind of try to avoid the effects of, big decisions like this. So, what does that look like for you guys?
Yeah, gosh. I'll take a quick stab at this, Rob. I'm sure you have things you want to jump in with, but the the interest rate, I mean, I said at the beginning, I would have loved for it to keep going up. We are in the private banking space, right? There's the public banking space, which everyone uses, checking account, savings account, local bank. And then there's the private banking space. The private banking space is insurance companies. And that's 100% reserve. They're not making money out of thin air. It's all accounted for. You pay interest to use the money, but it's not devaluing the overall currency. You're not paying a hidden cost later, right? And so and it compounds all the time because interest is just the price of time. And so we're operating in the private banking space with insurance policies. And the more time that interest rates stay elevated, the better these insurance companies are going to be positioned. my deposits, and I use that term loosely, it's not deposits. We're not allowed to use banking lingo, but the longer period of time that these insurance companies have money sitting in their accounts, premiums coming in, and the interest rates are up, the more time that they're going to lock in high interest rate bonds. They're the best bond brokers on the planet. And they're going to be getting a nice, big, healthy portfolio and turning over their bonds, getting nice high interest rate, guaranteed product under their umbrella so that they can pay healthy dividends to their clients. They can expand, right? And I'm here for that because I own those companies. I'm one teeny tiny little portion of the ownership of those companies. And I get paid for that. I get a dividend when they make money. And guess what? They make money. So I'm all about it. I wish that we would keep things a little higher. It's okay for interest rates to be higher if you're making wise decisions with what you're doing, right? I don't need free money all over the place. That has all kinds of bad incentives that we've already talked about. I just want there to be a well-coordinated, genuine economy. To use the example that Ludwig von Mises, talking about Austrian economics, right? Mises would say, if you have the wrong interest rate, it's like you're building a house, but there's improper signals, prices of things. Interest is a price. Prices of things are telling you that you need more wood over here, and you need more stone, and you need more bricks. You need different amounts of stuff to make this house than you actually need. And then you build 90% of the house, and then all of a sudden, you don't have enough bricks. Well, I planned this whole thing out. I have a blueprint. What's going on? It's because you don't have the right blueprint. Somebody's been messing with it. Somebody came in with an eraser and messed stuff up. And you're like, well, I can't finish. It's because the interest rate is wrong, right? So we need a real market interest rate, and it would be much higher. It's my opinion. What do you think, Rob?
Yeah, I mean, when I think about a lot of how people feel in these situations, they probably don't care a whole lot whether the interest rate is up or down, the average person. And that's fair. Like I get it, but they do notice it when they do go to purchase things. And I would say that if we had a higher rate, I actually do think it would be much better for the average person, even though it doesn't feel like it. It would be a good thing. But I think more importantly, the reason that, you, myself, others that practice this concept, the reason it's less of an impact to us is that, just like you said, we are operating in a 100% reserve situation. And that creates a lot of stability. And there's a lot of contractual guaranteed growth that's taking place in the place where we're depositing, you know, through premiums, depositing our money. And it's growing all the time. And when that company, as you mentioned, is performing more effectively each and every day, it just benefits those policyholders, those additional owners in the company. And that the great part about that, though, is if there's some sort of downturn or there is a major issue within the economy, it positions us to have dry powder, so to speak, to be able to put into action and use it. And that it gives me a lot of confidence for my family. It gives me a lot of confidence for those our clients. There's lots of things from that angle that higher interest rates actually would benefit in some respects, but it this whole concept in having this process in place, actually just made a post about it today, just like how much money you're able to save over time had you had these things in place is unbelievable. In my situation, we would have been able to save like over $61,000 had we opted to create the system sooner. And that was off of 2 vehicles. So like, that's the type of thing. These are real world, real life-changing numbers that we were able to do for people. And that's a lot about what we do.
And there's one other thing that I want to say on this too, because I was just having some good conversations this morning. Like, if you don't like all of these huge multi-billion-dollar equity firms and things buying all the real estate that's available so they can turn it into rental income, if you don't like that, if you don't think that's a good thing, I'm not telling you if it is or isn't. I'm just saying if that's something that your gut is to say, hey, maybe BlackRock shouldn't own all the real estate in the world, right? If you feel that way, you know why they can get all that? It's because interest rates are low. I'm sorry, blacks. Yes, thank you. I do that every time. It's like Arkansas and Arizona. I don't even know what the difference is. Okay, I'm kidding. I'm kidding. But if you're not a fan, then you should want higher interest rates, right? The reason they can do it is because it's practically free for them to do it in the long run, right? All they got to do is get somebody in there renting. Done deal, right? If you make it cost money to do real estate acquisitions, changes the landscape a little bit. Just saying.
Right on. Well, you actually said a lot of really good things, and even someone like me who follows you guys and knows what you're going to say most of the time, definitely with some good insights even to me. So, why don't you tell these folks about the toolkit they can get and set them on their way?
All right. Yep. Thanks so much, as always, for joining us on this week's episode of the Between the Lies podcast. If you watch the full episode, you're clearly interested in the future of money, and we can help you with the future of your money. We'll demystify that for you. Just head on over to perfectspiralcapital.com/podcast and get a free toolkit with a whole bunch of good stuff in there to help you understand what we're talking about with the life insurance and all that, and how you can deploy that in your own life or small business. Thanks so much for watching.